Дэлхийн банкны Монгол улс өрнөлтөөгч тэгээд энд миний хажууд мөн Монгол банкны дэд ерөнхийлөгч байна, мөн ерөнхий сайдын эдийн засгийн зөвлөгч байна. Тэгэхээр энд үүнээс гадна бас олон байгууллагын зөвлөгч хүмүүсээс оролцож байгаа.
Sorry, we couldn't get a translation of that from Ulaanbaatar. Let's just try Indonesia in Jakarta. We'll try to get back to Ulaanbaatar if we can get a translation of those questions. Indonesia, any questions, please?
One question and one comment, if you will. Question is in regards to increasing oil production. We are having a lot of difficulties in this area. Could you go into a little bit more specific? Okay. And now a comment in Indonesia. The problem has always been in the case of inflation, not so much demand driven, but it's more of a cost push situation. So I would think that the macro policy or structural policy will take a bit longer to have some effect on the adjustment. It's not so much the monetary policy. It's more on the structural policy, increasing infrastructure and so on. Just a quick comment on that. Thank you.
Thank you for that. If we could just get a quick question from Papua New Guinea, and then I can put them to Romwald and also Hans. PNG?
No questions from thank you yet. Not yet.
Okay, thank you very much for that. Ulaanbaatar, we might just try again. If we have a translation now, we could try your question, please.
Hello? Stanley?
Can you hear me?
I can hear you very, very faint, though.
Okay.
No, sorry for that. Someone's speaking over the top of you. I can hear you, but then someone else comes in over the top. We will definitely try to get back to you, though. One question from Timor-Leste, if they can.
Stanley, thank you. So far we have no question. Maybe later. Back to you.
Okay, thank you for that. Let me go to Romwald straight away and get a response just to that question about increasing oil production. How? Some specifics?
In terms of increasing our production, I mean, this is of course not a very easy task to achieve, but there are, I think, maybe two remarks really. First of all is that as I've shown, I think there has been really an increase in the cost of exploration and production as we are moving in terms of oil field from those who are more easily accessible and those who are very cheap to access and to produce for, to those who are actually a bit more remote and who may require actually higher level of investment as well as higher level of technology in order to bring them onshore. So there's really a very large amount of investment that will be required to increase the supply of oil and try to come up with new sources of production and new oil fields. So the first requirement, the first lesson is really that there's an increased need in terms of amount of investment that will be needed, and which so far has not been actually translated into reality. As I showed you, I think somehow in one of my slides, we have not seen really an increase in oil investment in real terms in the past few years, despite the increase in oil prices. The only increase has been really from the mill side. So I think there's really a need to make sure that the response from the investment side comes up, and therefore there's maybe some role for policies in order to facilitate investment into oil production. The second possible set of policies has to do also with possible constraints by international players into accessing some specific parts of the world. As I indicated, I mean, there has been an increasing role played by national policies in order to access to oil field and explore those particular oil fields. But given the needed requirement in terms of amount needed and resources needed, as well as technology required to access some oil fields that could be interesting for production, there's really a need to allow greater investment into the field, not only on the domestic side, but also to allow international players also to access those potential new supply of oil.
Romwald, thank you very much for that. On that note, we'll have to let you go. I know you have an urgent appointment and you need to leave us here. Romwald Semblat, the Senior Economist with the International Monetary Fund, thank you very much for your contribution today and also yesterday to our seminar. Really appreciate it. Thank you. Before I go around to get some other questions for Hans Timmer, Hans, I'd just like to pose something to you. It's a point that you brought up yesterday, and I think it's an interesting one. We're talking here about the pressures on inflation, particularly coming from the developing world, and we're seeing inflation spike up throughout the emerging economies. But the growth in emerging economies and the developing world actually contributed to keeping inflation lower in recent times, didn't it? So there have been pluses and minuses.
Yeah, there have been pluses and minuses, but they don't necessarily appear at the same time. The big pluses were very evident in the period between, say, 2001 and 2006, but more recently the minuses, the impact of developing countries on inflation has changed significantly over the last 2 years. What happened in the beginning was a sudden increase in production to the global markets, an increase in productivity, as a result of which you could argue there was a surplus capacity for tradable goods. That is basically the same as suddenly having an additional supply of labor in a country, which reduces inflation. But as a result of the very high growth that generated not only supply but also demand in those developing countries and in the rest of the world. The countries are using now up the capacity that was created and start hitting the constraints on the capacity side. So no longer then you have a situation where the products are becoming cheaper and cheaper. And many developing countries are seeing now pressure on their wages also, because you see the beginning of tensions in labor market. And on top of that, the generally high growth has created a lot of demand for commodities, and not for agricultural commodities, but for metals and oil, and that also contributed to the inflation. So you see a changing role of the developing countries. What was very easy going a couple of years ago becomes much more difficult to manage now recently.
Thank you, Hans. I must make a point here that Ulaanbaatar continues to have the technical difficulties, and they will be an observer until we can sort those out. We will definitely get back to you as soon as we can sort out those technical problems. Let me go to Bangkok and see if there are any questions that you'd like to pose to Hans Timmer from there.
Right. Hi, Stanley, and good morning to all of you, and good evening to Hans. We have two questions here, Hans, for you. One is that concerns the monetary policy that both of you kind of suggested that monetary policy should be tightened, that is, interest rates should rise in the face of rising inflation. But then again, as Romuald mentioned, there are trade-offs to doing that, particularly on the growth side. And when you mentioned that many of the developing countries are hitting a supply constraint, and this inflation is more of a supply of cost push, raising interest rates to suppress demand even more, wouldn't that affect growth in the medium to long term more than help? So what do you think? How do you see these trade-offs playing out? That's the first question, I guess. The second question is that both of you are saying that high inflation will be around and for a while. But looking at your graphs, we see that inflation next year or the following year is on a down, sort of like a downward trend. So it's a little, it's coming down a little bit. So what do you make of that? Is it because it's coming from a high base already? Because in your projections, I can see that, for example, inflation next year is projected to be a little lower than this year. So thank you.
Thank you, Hans. Those questions, I suppose, the pluses and minuses of monetary policy, will it have a short-term effect of slowing the economy and putting more pressure on those economies? And also the question about inflation, if it's going to be around for a while, what are the projections? How high will the increases be? Will it tail off?
So no clear-cut answer on both questions because those are both very difficult. On the first one, it is for me not that clear that monetary policy has to be tightened in all situations because we see inflationary pressures. Especially not in all developing countries. And that is because of the reasons that were given in an earlier question, which were perhaps not completely addressed yet. The earlier question stated that we don't see inflation at the moment because of printing money, because of demand pool, but much more because of cost push factors, because of problems in the infrastructure, and that is very true. It is not the case that in all countries now we see very loose monetary policy, governments are printing money, and as a result of that you have inflation. The answer to that situation would be very simple and very clear: tighten monetary policy. But actually there are only a few countries at the moment where you see significantly too loose monetary policy. And basically these countries are in Latin America, where you see in Bolivia, in Venezuela, Argentina, probably that kind of a process. And then there are no countries left with hyperinflation. Zimbabwe is the only example where money is being printed. Now, if it's not coming from too loose monetary policy, then the situation becomes much more complicated. It could indeed come from supply constraints. You don't have enough infrastructure, you don't have enough power supply, and what you would like to do is have more investment, which you are not getting if you're increasing interest rates. And there might be other options to increase the investment so that you loosen the capacity constraint and at the same time reduce the inflationary pressure. One possibility is to, if you have a very sound financial situation, if you have surpluses on your current account, or at least not struggling with deficits on your current account, and if you have, like several countries have at the moment, an exchange rate policy that is pegged to the dollar, then one option could be to let the currency appreciate somewhat, as a result of which it is cheaper to import investment products that can be used then to solve the problems on the infrastructure, the constraints there, and at the same time the appreciating currency helps reducing the immediate impact of the international inflation.
Sometimes just by doing that through increasing interest rates is generating perverse effects. What you see in some smaller countries where you have a problem with too much spending domestically, too much credit creation, if they increase the interest rates, then a sudden inflow of capital creates actually even more credit creation domestically with even more inflationary pressure. So not in all cases the monetary policy trying to reduce demand by higher interest rate is effective in countries. Much more effective is either a different stance on exchange rate policy or tightening fiscal policy, trying to make room in society to spend more on the bottlenecks that exist. But of course, that is not always possible. It is not always possible, and sometimes if you find foreign direct investment funds to create additional infrastructure that brings in more money, can have second order effects which create then more spending in an economy and leads to higher inflation. To avoid then the inflationary spirals and the inflationary expectations, you perhaps at some point have to tighten monetary policy also. But if the problem was not caused by printing money, say, then that's not necessarily the first place to look. Well, at the same time, also you shouldn't loosen monetary policy just because you see a slowdown in the economy. Then on the question whether inflation will be high, that's also not clear cut for me. I do think that most of the inflation that we are seeing at the moment are the direct impact of an increase in commodity prices. And even if we expect that commodity prices remain high in the next couple of years, that doesn't mean that the increases in commodity prices that we have seen recently over the last 12 months, a doubling of the oil price and more than doubling of internationally traded food prices, that increase will remain the same. And it is very likely that in some of the food markets we have seen the peak. We don't expect the prices to fall. We expect the prices to remain at relatively high levels. And that means that there is no additional inflationary push in next years. And the same is actually true for the oil market. Now with oil prices at 125, it is very difficult to imagine that we will see another year of doubling of oil prices, and that oil prices a year from now will be 250. That means that the direct impact from commodity markets on inflation will actually soften in next year. And the big danger is not so much coming from the commodity markets, but it's coming from second round effects. What will happen now after the commodity prices have increased? What will happen with the wages? What will happen with other product prices? Do we see now the start of an inflationary spiral? And that is quite possible, but it is not a clear-cut conclusion that it definitely will happen. And in that sense, there is somewhat of a window of opportunity that if the current situation is addressed well, that still the inflationary spiral, as we have seen in previous decades, can be avoided. Thank you, Hans. As Hans pointed out there is no one-size-fits-all when it comes to dealing with this question. Different countries having to deal with different pressures, some pressures of infrastructure and some other issues of monetary policy that's too loose. I think Hans mentioned a couple of countries there in Latin America, and Latin America has had a lot of experience in dealing with incredible rates of inflation, particularly during the 1970s. Igor Magenzo is here. He's the advisor to the Central Bank of Chile. He'll be giving an address after our break. But I'd like to bring you in now, Igor, just on this question about the effectiveness of tightening monetary policy and the suite of policies that may be needed to deal with a problem such as we're seeing at the moment with the pressures on inflation.
Well, I agree with what Hans has been saying. I think one lesson we have drawn in Latin America from many years of high inflation is that first of all you have to act preemptively. So if second round's effect, you should not wait until you see second round's effect being actually there to act, because once they are there, once expectations are increasing, once indexation is kicking up, it's too late to act, and will be more and more costly to act. So you want to act preemptively and be watching these indicators very carefully, and maybe giving some signals, a lot of signals from the central bank, take a more hawkish position towards the future, make signals that if expectations go up, if indexation start to keep up, if fiscal spending start to indexate itself to inflation, then the central bank will act, and will act on time and aggressively. Maybe that will divert agents, and the need to act will be smaller. Also, we have to take into account that when you have a cost push shock like this, which is very similar to what we are having in Chile, is very similar to a productivity shock, and potential output goes down. Simply the economy cannot produce as much as was able to produce before at lower prices for imported goods, especially energy prices. So it is important that demand adjusts to this new situation, and if demand does not adjust automatically, then there is a role for central bank and for the fiscal sector to reduce the rate of growth of demand, to adjust to this new situation and make space for expenditure on items that are now more expensive. You cannot continue with demand growth similar to that you had with low prices. So I think these two factors are important. When you have a cost push factor, there is a role for monetary policy to make sure, and for fiscal policy to make sure, that demand grows at a reasonable rate. And second is that you want to act preemptively and show that you're ready to do whatever is needed in order to keep inflation low, because otherwise you might get too late to it.
Thank you very much for that, Igor.
Could I interact here?
Yes, Hans, please, by all means.
Yeah, I had one follow-up question then. As far as I understand, the Central Bank of Chile reads the current situation very different from the Central Bank of Brazil. In Chile, it is much more a waiting position, characterizing the current situation as a sectoral problem and not necessarily as an overall inflation problem, while the Central Bank in Brazil immediately reacts and try to preempt probably the inflationary expectations. Do you see that difference also, and who do you think is reading the signals right at the moment?
I think Chile is reading the signals right, of course. But no, seriously, I don't think the reading is that different. Chile started rising interest rate in mid-2007 and has risen interest rate by more than 100 basis points, even 150 basis points in this year and less than a year. So I think Chile has been going to a more hawkish position. It stopped raising interest rate by the beginning of 2008, mostly because starting to worry about the exchange rate that was too appreciated beyond whatever we could explain. But with yesterday we had a reading of CPI inflation of 1.2% monthly inflation, and market was expecting 0.6, and that totally changed the panorama. So now the central bank has a more hawkish speech, and we will see what the central bank does this Tuesday in its monetary policy meeting. But market started already raising its expectation of interest rates because the central bank has said over and over again the Central Bank of Chile, that any signs of second round effects will induce a reaction by the central bank, and I hope the central bank puts its action where its words are.
We do have Mongolia back online now. Before we go to them for a question, I just wanted to get a bit of a follow-up from you, Hans. Actually, it appears to me, just listening to the discussion, that we could be seeing countries in a bit of a bind here. There is a need, as Igal has mentioned here, to act preemptively. You've also said there is a need to choke off the secondary pressures that may force inflation up. Also passing on the full increase of oil, for instance, throughout the economy to decrease demand. All of these issues are going to involve some pain, particularly for those most vulnerable in those communities, and that means there's going to be internal pressures, political pressures on governments to try to deal with that. How do you see governments being able to traverse that terrain, and what sort of measures can be put in place to protect those who are most vulnerable?
This is indeed a very difficult policy dilemma, because for many developing countries, in my view, the most powerful policy reaction is actually fiscal constraint if you see inflationary pressures. If you take a couple of countries in Central Europe as an example, countries with large capital inflows, large current account deficits, and increased credit creation domestically, in the beginning used for big investment programs, but more and more now used for consumption. Almost the only option that you have to turn this around is very tight fiscal policy, because there you see what I mentioned before, that if you try to raise interest rates, actually only more capital is flowing in and more demand is being created. Now, so you have to tighten fiscal policies, while at the same time you want to support with fiscal measures the most vulnerable, because it is not an option to try to prevent the increase in the commodity prices in the country, because that gives the wrong price signals and it gives the wrong adjustments, and ultimately it is not targeting the right groups. You have to go with targeted cash transfers to the most vulnerable group, and that is spending, and you will have to find revenues for that. So while you have to reduce your spending overall, there is an issue now that not only for political reasons, but just for sound economic management, you have to support some of the most vulnerable people in your countries, and that means that the tough decision has to be made that some of the longer-term projects, some of the spending categories that you can postpone or not necessarily need are being cut, or that in this situation you try to find through fiscal measures additional revenues. But the most effective reaction is more fiscal constraint.
Hans, thank you very much for that. Let's go now to Ulaanbaatar. I believe we've fixed the technical problems that we had earlier. We'd love to hear from you. So any questions that you have, and we can then address them to our participants. Ulaanbaatar.
Stanley, can you hear me, and is everything okay?
That is now terrific. Thank you very much. Thank you very much for your patience as well.
Okay. Let me just throw a quick question here and give you a sense of where Mongolia is. Mongolia has the highest headline price inflation in East Asia, the highest food price inflation in East Asia. About 70% of the inflation is, directly imported price inflation, because Mongolia is a landlocked country. And I have here with me the advisor to the Prime Minister, and I'm glad that the last two, have tried to focus a little bit more on the fiscal side, because I agree with Hans that I think in countries like Mongolia, there's very little room or less space, if you will, to use the monetary levers. And you've been raising successive interest rates. We've seen increase in the reserve ratios and sort of the traditional tools that we've tried, and things haven't worked. So I think it's good that we're now focusing on the fiscal side, and there maybe it'd be useful to sort of hear a little bit more on sort of lessons that we are picking up from countries that have been maybe more active in doing this, and I see Deepak as well there. So maybe we could hear a little bit more on that. And let me just turn over to my colleagues here and see if anybody else has a question here. Yeah? Good. Okay, that's it.
Thank you very much for that. We will go around all of our participants and get a response from this. Igal, can I just start with you, because you've talked a lot about monetary policy, but there is a fiscal response here as well. Any international experience you can bring to bear that may be useful in Mongolia?
Well, definitely our case is quite the contrary, and I would say that's the common case in Latin America. It's much easier to use monetary policy than fiscal policy. And I would say that the fiscal Latin America is doing a fiscal effort that is unprecedented, and even though even said that is probably not enough. The strongest case is the case of Chile, where we have implemented a fiscal rule that enabled the country to not to overspend in these situations where on the one hand there is a lot of pressure to protect the poorest part of the population, and on the other hand income of the government is increasing very rapidly, because government owns primary goods, copper in particular. Copper prices have risen a lot, so the government is sitting on a huge surplus, and thanks to the fiscal surplus the government has been able to increase spending only by about 9% a year, which is already a lot. So I would say countries in Latin America are doing a huge effort, but the main maneuver lies on monetary policy, and I think that we are now getting the benefits of having independent central banks, having a well-established monetary policy with clear targets and a flexible exchange rate. Now we are seeing the benefits of all these policies that were implemented during the first part of this of the 2000s.
Deepak, do you have anything to offer, particularly if we've heard there about the specific circumstances that Mongolia finds themselves in? There's not enough room to manoeuvre with monetary policy. They do need to look at other measures, yet at the same time they're dealing with the highest rates of inflationary growth in food prices, the highest headline inflation in East Asia. Any specific suggestions you could bring to bear there?
Thank you. It is difficult to formulate an anti-inflationary policy specifically for Mongolia through a video interview, and this will have to be taken up in greater detail with the policymakers. But let me just focus a little bit on the question that was asked, and that is, in addition to the standard package of monetary and exchange rate, coordinated monetary and exchange rate policies that we're talking about, what specifically might countries like Mongolia do in using fiscal tools? Now, the starting point for this probably is to recognize that short of a deflation in international markets, commodity markets, and in the oil, specifically in the energy market, you cannot expect any pressures, deflationary pressures, to come in from the external sector immediately. And therefore you are planning your inflation management strategies for a slightly longer term. Specifically because in countries where the transmission mechanism from central bank actions to the balance sheets of firms and farms isn't very robustly developed, we aren't very sure how long these effects will take to actually manifest themselves in the behavior of the firms and farms. So recognizing that this may be a slightly long, drawn-out process, what can you do in the area of fiscal policy now to start moving fiscal policy in the same direction and reinforcing the effects that you might be getting from the standard monetary and exchange rate policy tools. Without going into the standard package, let me just focus on one element of this which is critical for countries like Mongolia, and that is we ought to recognize that during this period of transition, there may be a need for an expansion in central government expenditures to preserve the safety net or to make the adjustment to higher prices, which we expect will be transmitted to the consumers. In such a situation, if you know that you cannot compress central bank expenditures substantially, you have to find your compression elsewhere. And in economies such as Mongolia and China, etc., it is very important in this context to look at quasi-fiscal expenditures and to look at off-budget spending. Because these are major elements of spending, often uncontrolled, and there is scope for some not just postponement of capital expenditures, but for some compression and examination of all kinds of expenditures over here. And interestingly enough, if that is the approach you take, and that is you try to get greater control over quasi-fiscal expenditures and the off-budget spending of state-owned enterprises or state-affiliated enterprises or other such bodies, statutory bodies, then the interest rate emerges as a very useful tool in this attempt, because essentially the sectors of the economy which are most sensitive to the price of capital will be those who have traditionally received virtually zero capital at zero cost. And for these people to start then paying a price for the capital will result in certain adjustments in behavior. So interestingly enough, monetary policy has a more complex role to play in an economy where such expenditures off the budget are quite substantial, and that these are being, this kind of expenditure is taking place with not just second-level governments, subnational governments, but also among public enterprises affiliated with the government or some such other agencies, statutory bodies and public services units affiliated with the government. So this may be another area to explore in our discussions with the authorities.
Deepak, thank you very much for that. Let me go to Hans Timmer for a final comment on this. Hans, it does touch a little on some of the area that we've covered so far, and that is the need to provide some cover for those who are most vulnerable, yet as we've also heard there from Deepak, the government in Mongolia perhaps needs to be a bit more flexible in looking at other areas that they can cut their spending. They can look off budget areas, for instance, as Deepak has suggested. Do you have anything to offer to that, Hans?
I must admit that I don't know Mongolia, and Deepak knows Mongolia much better. Some general remarks, therefore. If you talk about a fiscal reaction to inflationary pressures, it is very important to understand where the inflationary pressures are coming from. And we had two elements in the discussion together. One was the imported inflation through commodity prices. The other one was also cost push, but through overheating of the domestic economy and capacity constraints. And those are very different sources, and probably you have to react differently to that also. First, in the case of an increase in commodity prices, that potentially is only a relative price change and not necessarily the start of an inflationary spiral. What you have to do with your fiscal policy is to make sure that you don't make the situation unnecessarily worse, and that you are not initiating a second round effect. And that means that in your attempt to protect the most vulnerable, that you use the most efficient measure possible, and that you avoid subsidizing much larger groups than is necessary, and spending a lot more than is necessary. And also what you see sometimes in countries, that in reaction to increases in food prices, one of the first measures is that the wages of civil servants are going up, and there are some examples where they moved substantially up, with which you are generating actually a general second round effect, and it's much better to try to avoid that, postpone that as much as possible, and to focus on the real vulnerable in the society. And then it is possible that with that kind of a careful policy, you can actually avoid the second round effect, and inflation comes down by itself if commodity prices ease. If it's a much more general inflationary pressure coming from the real economy or coming from capital inflows from outside, as a result of which overall demand in the economy exceeds supply, then it's much more a general approach that is needed, and the step that has to be made, and is not always made in countries, that in the design, the longer-term design of fiscal policy, the focus is not just on the fiscal position, the fiscal deficits, the fiscal debt situation, whether that is sustainable or not, but that you take into account the overall situation in the economy, and that what for other countries or in other situations might seem to be an overly prudent fiscal stance, because there is actually no fiscal debt problem, can be very useful in the current more general macroeconomic situation. And that is a kind of a view of fiscal policy that is not always taken, because always a more narrow view is, many times a more narrow view is taken.
Hans, thank you very much for that. On that note, we will say good night to Hans. It is getting late there in Washington. We're going to take a bit of a break here now. Hans, thank you so much for your contribution, both yesterday and today. I think we're having a great discussion here, and we're really getting to the nitty-gritty, I think, of some of the peculiar issues that face individual countries when we talk about an international problem such as inflation and try to get to an integrated policy response. And Hans, your contribution has been terrific. So once again, thank you very much for your
It was really my pleasure. Thank you.
Thank you so much. We will take a break here. 10 minutes. We'll meet you back, and we'll convene then for Igal Magenzo. He's the advisor to the Central Bank of Chile. Very interesting experience to share with us about how they've tackled inflation in the past. And once again, we'll have some questions at the end of that. See you all in about 10 minutes.
Stanley, one question I had for you. He's gone off.
Yes.
Would we cover the bank's recent announcement of this facility that the bank has put in place for countries? Will somebody share some information on this, or?
Yes, perhaps Deepak can share that after
just briefly.
10 minutes. We will come back.
Yes. Okay.
Thank you.
Okay. Sounds good.